This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Race to the finish. The stock rally picks up steam into the closing bell. But after days of violent swings, is Wall Street satisfied with the bounce back? Jackson hold. Are the odds of a September rate hike eroding as central bankers grapple with a global economic mess? New tax, why a quarter of all U.S. employers could soon face some hefty fees on their health plans. All that and more tonight on Nightly Business Report for Wednesday, August 26th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off tonight. The move higher was massive, culminating in the Dow's third biggest point gain ever. It was the exact opposite of yesterday, when the rally turned into a head fake and selling intensified into the close. Today, the buyers came out in force, snapping 6 days of dramatic selling. And at the close, the Dow Jones Industrial Average soared 619 points to 16,285. The Nasdaq rose 191 points, having its best day in 4 years. And the S&P rallied nearly 73 and has emerged out of correction territory. But with questions about global growth still lingering, was Wall Street satisfied with that rally? Bob Pisani reports from the New York Stock Exchange.
It was another wild day, but with a very different ending. It started like yesterday with a 300-point move in the Dow at the open. But unlike yesterday, we began rallying midday and we just kept going. The issue that sunk the market yesterday was not much of a factor today. After 3 p.m. yesterday, waves of orders to sell stocks at the close started hitting the floor, very large numbers. When traders saw this sell imbalance, they sold ahead of it, and that exacerbated the big sell-off we had yesterday. That did not happen today. Sell orders at the close were relatively muted. So is this the bottom? It's really too early to say. The floor was certainly happy to see a rally into the close and on very big volume. But even though the rally held into the close, I think traders continue to believe that the market remains a bit sketchy and are not convinced that this is necessarily a sustainable upside. Caution will be the theme near term. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So, with investors still cautious and traders skeptical that the optimism can be sustained amid doubts about China's economic growth, how can investors know if the market is in for a longer-term bounce back or positioned for a prolonged pullback? Dominic Chu navigates it for us.
To buy or not to buy, that is the question. Many stock market investors are trying to figure out if the recent volatility is a reason to stay in or get out of the action. There are a number of reasons why the stock market rally could march on despite the recent sell-off. Some experts point to lower oil and gasoline prices as being beneficial to consumers. Others say that the relative value of stocks is now more attractive given the pullback. But it may be too much to expect massive gains for stocks in the coming months.
You have corporate earnings that, although the rate of growth has slowed, are still growing. You have, regardless of what the Fed does, you still have historically easy money. And you have a properly sloped yield curve. So you generally don't see bear markets start with those characteristics. So I think money can be made in stocks. I just don't know if you're going to see the stock market returns we've seen the last 6 years or so going forward.
Of course, for all the bullish commentary, there are still reasons for caution as well. Those same lower commodity prices could take a bite out of energy company profits. There are also global economic risks, especially from China, that could continue to be a drag. And of course, there's the Fed and interest rate policy.
If the Fed doesn't raise rates, then it could signal to the economy or to the markets that they're worried that something systematic could be problematic for the economy. So I think it'd be far better if the Fed just gets on with it. The world is never going to be puppy dogs and rainbows.
One thing is more certain. The market volatility has given people a reason to think about their portfolios and what kinds of investments are appropriate given each person's tolerance for all the ups and all the downs. For Nightly Business Report, I'm Dominic Chu.
Another key piece of this market puzzle is the Federal Reserve and when it will raise interest rates for the first time in nearly a decade. And over the next few days, central bankers will tackle head-on the stock market turmoil and its looming decision on rates. Steve Leisman reports from the annual Kansas City Fed Symposium in Jackson Hole, Wyoming.
As central bankers from around the world ready to meet in the shadows of the majestic Teton Mountains in Jackson Hole, markets look more like this after 5 days of extreme volatility. That's led a leading Fed official today to suggest the odds of a September rate hike from the Fed are eroding.
From my perspective, at this moment, the decision to begin the normalization process at the September FOMC meeting seems less compelling to me than it was a few weeks ago. But normalization could become more compelling by the time of the meeting, as we get additional information on how the U.S. economy is performing.
Dudley, who along with Fed Chair Janet Yellen is not coming to Jackson Hole, said Chinese economic weakness, the strength of the dollar, and recent market gyrations all combined to make the chance of a hike less likely in September. But he wouldn't rule it out since it's still 3 weeks until the next meeting and lots of data to come.
A lot can happen between now and then. We'll be very sensitive to what happens to the employment numbers a week from this coming Friday, and it looks like you're probably going to get another decline in the unemployment rate.
A new CNBC Fed survey finds that Wall Street economists now expect a later first Fed rate hike than they did previously, moving the expectation to December from September. But nearly 40% of the 26 surveyed still see the chance of a September hike. The irony is that U.S. data has been reasonably strong recently. Just today, the government reported that business investment in July rose the most in a year. But the Fed is cautious about recent developments.
The slowdown in China and the sharp fall in commodity prices are increasing the strains on many emerging market economies, and this could lead to a slower global growth rate and less demand for U.S. goods and services.
Some thought the Fed in Jackson Hole might go for a hike in the mountains, solidifying the case for a rate hike. But it looks more likely that the Fed in Jackson Hole is, at least for now, going to be on hold. For Nightly Business Report, I'm Steve Leisman in Jackson Hole, Wyoming.
And tomorrow from Jackson Hole, we'll hear from Kansas City Federal Reserve President Esther George, and Federal Reserve Vice Chair Stanley Fischer is scheduled to speak on Saturday. So how resilient is the U.S. economy, and are the problems in China and other markets a threat to our economic growth? We turn now to Joe Davis, Chief Economist at Vanguard, for some insights and answers. Joe, good to see you. Thanks for joining us tonight.
Thank you for having me.
Let's start with China, because it seems to be the flashpoint right now. We've obviously seen financial impact in our markets. What about the economic impact that a slowdown in China might have?
Well, I think that's really the critical question, Sue, because it's the economic, it's really China's economy that should be the focus, and not really its equity market, despite the focus on the recent volatility. We've had concerns for the past year that many sectors within China, particularly the manufacturing sector, was growing potentially much weaker than was widely appreciated. I think some of those concerns are becoming much more commonly appreciated. And so that obviously has already had some modest impact on some parts of the U.S. economy.
Do you believe the numbers that are coming out from China in terms of their growth, or do you think they're exaggerated, even though they're lower numbers than we've seen in the past? Do you think they're actually growing at a 7% rate, or perhaps even better or less?
Well, I think more importantly is that some of their measures just tend to be less volatile than one would expect from just economic statistics. So I think the leading indicators we look at suggest that potentially they will not officially reach their 7% growth target this year, perhaps as early as the third quarter. And I think that paired with some of their recent depreciation of their currency, I think those two combined had some role to play in some of the market volatility that we've seen.
Where does this put the Fed? That's the big debate on the street right now.
Yeah, well, I think unfortunately, and I really stress the word unfortunately, this volatility does come at an unfortunate time, because I think until that time I was firmly in the camp that September, despite some suggesting it was a close call, I think the Federal Reserve was going to very well raise rates, begin the normalization process. I think it's hard for them to be, quote unquote, reasonably confident that inflation will have, started to march upward, just given another ferocious leg down in commodity prices. I don't think it's the equity markets that may lead them to pause. It's much more the second leg down commodity prices and the weakness in emerging markets that may lead them to pause.
What about your investors? What are you hearing from them surrounding the market volatility of the past 4 or 5 days? Are they nervous? Are they holding pat and just kind of letting Wall Street do what it needs to do to normalize? What are you hearing? Yeah, well,
amazingly, they are standing pat. Clearly, we are hearing from them more. They are certainly more interested. Just the headlines, certainly, the increase in, say, log-on accounts and call volumes are up roughly 50%. What, again, relative to what typically are slow August. But
Right.
I think call volumes have been actually in line with what we see, say, during a tax season. I would say the transactional activity has been much less, high or elevated, and has actually been much more balanced on both sides of the ledger. So nothing that I would see actually be commensurate with the sort of volatility that we've seen in the market. So actually fairly balanced.
Well, Main Street's smarter than Wall Street, I think. Joe, thank you very much. Joe Davis
you,
with
Sue.
Vanguard. A $13 billion buyout in the energy sector. Schlumberger, the world's largest oil field services provider, will buy Cameron International amid the downturn in oil prices. Shares of Cameron soared 41%, while Schlumberger fell more than 3%. That deal comes at a time of increased consolidation in the industry as companies cut back on spending and try and shield themselves from plummeting crude oil prices. And speaking of which, today West Texas Intermediate settled at $38.60 a barrel, down nearly 2%. Gasoline prices also dropping, which would make it an odd time for an automaker to roll out a new car that doesn't run on gas. But that's what Toyota is doing, and we'll bring you that story just a little bit later in our program. Falling oil prices prompting Transocean to cut its dividend. The offshore rig operator plans to stop investor payouts as the fall in crude prices weakens demand for its drill ships. At a special shareholder meeting in October, investors will be asked to approve the cancellation of the final 2 dividend payments of the year. That pressured shares, which fell almost 5%. Coming up, the Affordable Care Act backlash, why a looming employer tax could be a big burden for companies and consumers. As individual investors grow concerned about their retirement accounts in this volatile market, Boeing has reached a provisional settlement in a class action lawsuit over the company's 401k plan. That lawsuit claimed the plan charged employees excessive fees. No details of that settlement have been released. So, how do you know whether the fees in your 401k plan are reasonable or not? Sharon Epperson is back with us with what you need to look for. So, Sharon, good to see you as always.
Good to be here.
So, what exactly are workers paying for with these fees in their 401k?
Well, there are a lot of different services that you're getting with the 401k fees: administrative services, transaction processing, regulatory fees, as well as investment management fees, and financial education as well for some plans.
Do we have an average of about how much those fees are?
It really can depend on the plan size, how many participants are in the plan, how large it is, and also what the plan is investing in. If it's in a lot of equity holdings, the fees may be higher. But larger plans, $1 million or more in plan assets, you might see the plan participant paying between 2.29% and 1.29%.
Wow, that's quite a range, though.
It is a big range. And again, the bigger the plan, the lower that fee is going to be. But a smaller company plan, we're talking about $500,000 in assets or so, they could see a fee of as high as 2 to 3%. So if you're really working for a small employer, you could see a much higher 401k fee.
So how do you know, or how can you find out whether the fees that you're paying are excessive?
Well, one of the things that you want to do is probably go to a website like brightscope.com. They do a really comprehensive survey of 401k plans, a lot of large company plans, some smaller company plans as well. Look at your plan and also a plan with the participants and the assets that are about the same size, and kind of compare to see where you stand and where your plan stands. That's one thing to do. Also consider the fact that it's not just the 401k fee that's eating away at your assets. It could be the mutual fund fees as well. So you want to know what's inside your plan and what those expense ratios are on those funds. Morningstar, a great resource for that. Personal Capital also has a 401k fee analyzer that you could go to online.
Okay, so I go to that website and I look at my plan and I get a little sticker shock. What can I do? Is there any recourse?
So when you go inside and you look at the different funds, maybe you could change to some index funds that are lower cost funds. You use those tools and find out if you change your holdings, would that lower the overall cost of the plan? And then think about this. You're still likely going to get a company match. Many 401k plans provide a company's matching contribution. That's free money on the table. So that may offset the fee that you're paying. For many people, they're not going to really save any other way. The 401k is a great automated automated way to save. And so it's better to put that money in a plan where you know you're going to have it for your retirement long term. Yes, you're paying a fee. You don't want to pay a high fee, but if you're getting that company match as well, it's a great place to put your money for retirement.
All right, Sharon, as
Sure.
always, thank you so much,
My
Sharon
pleasure.
Epperson. Impressive quarterlies from Express is where we begin tonight's market focus. The retailer easily beat estimates on both fronts and raised its 2015 outlook and lifted guidance for the current quarter. Its same-store sales also trumping estimates. The better-than-expected numbers came as the company scaled back on promotions. Shares surged nearly 20% to 2025. Also, a strong day for another retailer, Abercrombie & Fitch. That chain posted a surprise-adjusted quarterly profit as its performance was helped by strong results at its Hollister brand. Shares rose 9.5% to $18.91. And rounding out today's reports from the retailers is Chico's, which also popped on better-than-expected results. The clothing company said it would sell its Boston proper direct-to-consumer business and close its existing stores. The stock was more than 6.5% higher to $14.75. And Monsanto dropped its nearly $50 billion bid for Syngenta. The Swiss company recently rejected a sweetened offer from Monsanto. So now Monsanto says it will focus on its core business and resume its share buyback program. Monsanto rose 8.5% to $97.08. Syngenta tumbled 13.5% to $67.51. The Affordable Care Act is back on the radar. A report released this week by the Kaiser Family Foundation says that about a quarter of employers that offer health insurance plans could be hit by the so-called Cadillac tax. That's a tax levied on the most generous health plans. That provision was designed to rein in excessive spending and help pay for expanded coverage. So how might that impact you if you receive health benefits from your employer? Larry Levitt is the Senior Vice President for Special Initiatives at the Kaiser Family Foundation. Larry, nice to have you here. Thanks so much for joining us.
Oh, thanks for having me.
So what will this mean for workers if these health care taxes go into effect? What net would be the bottom line impact?
Well, I mean, this is a very significant tax. It's 40% on health insurance premiums that exceed certain thresholds in the law. And no employer is going to want to pay this tax. I mean, it's such a substantial amount, and it's very complicated to figure out the tax. So employers are going to do everything they can to avoid it. And most likely what that means is employers are going to trim back benefits. They're going to raise deductibles, raise copays. So for workers, they can expect more of that to happen. It's been happening for years, but this tax will really accelerate the trend.
If it doesn't go into effect until 2018, why all of a sudden is it back on the radar?
Well, yeah, I mean, 2018 seems like a long time away, and it really seemed like a long time away when the Affordable Care Act passed in 2010. There are a couple reasons. One is there's a big political push now to repeal the tax by employers and insurers and healthcare providers. So that I think is really putting it back on the agenda. And employers are starting to look at what they're going to do, how much tax they might face here and what they're going to do to avoid it.
A lot of people use health savings accounts and other types of accounts to help supplement. First of all, it's a tax advantage for them in many ways, but also it helps them make up for the difference between the deductible and perhaps what they owe the doctor or a hospital, et cetera. Will this tax affect that or their ability to shield that income?
It does. I mean, the tax is quite sweeping. It doesn't just affect your standard health insurance benefits, but it also hits health savings accounts, health reimbursement arrangements, flexible spending accounts, even on-site clinics that employers might offer. So all those benefits go into figuring out whether an employer would face a tax under this provision.
If it's not going to be repealed, and you mentioned the fact that there's a big pushback by various companies and others, is there a chance that perhaps the tax could be reduced? I mean, is there wiggle room, a negotiating room, if you will, or no?
Well, final regulations haven't been issued, and those will certainly affect how much any one employer might face in the tax. But there could also be congressional efforts to scale back the tax or allow the thresholds under the tax to grow faster over time. Right now, they grow just with inflation. There might be certain adjustments for regional cost of living. So, 2018 is still a ways away, and there could definitely be changes between now and then. We also have an election coming up.
That's right. I was just going to say, and it's an election cycle.
That could certainly affect things as well.
All right, Larry, we'll leave it there. Thank you very much. Larry Levitt with the Kaiser Family Foundation. Coming up, Katrina, 10 years later, and how one New Orleans hospital that witnessed that devastation firsthand has transformed since the tragedy hit that city a decade ago. Here's what to watch tomorrow. A preliminary reading on gross domestic product growth for the second quarter. That's the broadest measure of economic activity. Weekly jobless claims are out, and we'll see how the labor market is doing. Also on the data front, pending home sales. And that's what to watch for Thursday. Sales of new vehicles are expected to fall 4% in August when compared to last year. That's according to Kelley Blue Book. A caveat, however, last year's results included sales from the Labor Day weekend, so those year-ago levels are harder to beat, and this doesn't necessarily mean demand is weakening. Gasoline futures, as we told you, dropped nearly 6% today as supplies rose. And with the price you pay at the pump expected to drop roughly $2 a gallon by the end of this year, it would seem like a strange time to roll out a new car that won't run on gas. Instead, the new Toyota Mirai will be powered by hydrogen. But will it sell? Phil LeBeau has more.
Meet the Mirai. Toyota's newest car looks like other mid-size sedans, but it's radically different. It's powered by hydrogen.
It's the car that lets you go 300 miles plus, refuel in 3 minutes, and drive like normal. So I think that's really what brings people to it.
Officially, the Mirai gets 312 miles on a full tank of hydrogen and is expected to cost between $40 and $55 to fill up. The Mirai's price? Just over $58,000. Toyota plans to sell 3,000 Mirais in America, almost all of them in California. That's because there are just a dozen hydrogen refueling stations open to the public in the U.S., and 10 of them are in the Golden State. Paul Berkman has been to many of them, filling up his hydrogen-powered Hyundai Tucson. He loves driving on hydrogen, but he says refueling can take up to a half hour, and some pumps aren't always working.
If I didn't live close to the stations, I wouldn't be a happy person. But I live close. I have 3 alternatives. So that's the only reason I chose this hydrogen, because I have 3 alternatives within a 2 to 3 mile radius. If there was only one, I'd kind of maybe think twice about it.
Toyota is confident California will add more refueling stations to support the Mirai and the very gradual growth of hydrogen-powered cars.
I like to say that infrastructure is maybe a generation behind the vehicle technology. So we'll get there, but it's going to take a little more time.
A new car and a new technology in a state pushing to get more clean-burning vehicles out on the road. Phil LeBeau, Nightly Business Report, Los Angeles.
And finally tonight, it's hard to believe, but it's been almost 10 years since Katrina, the costliest natural disaster in U.S. history, when it slammed into New Orleans, overwhelming that city's infrastructure, causing floods, death, and displacement. And there was one hospital in New Orleans that witnessed that tragedy and began its own transformation. Bertha Coombs has the story.
1, 2, 3.
Most hospitals don't have their own Navy, much less flood rescue drills.
Boat 2 now leaving evacuation hospital.
Ochsner Baptist in New Orleans does because of Hurricane Katrina.
My job was to man the waters and try to corral any boats that we could to start evacuating the ambulatory patients.
10 years ago, Glenn Casey helped save patients when the waters rose. He would spend much of the year after helping to save the hospital itself.
I had practiced there for 30 years. I was born there. I couldn't see that institution going away.
But after Katrina, nearly half of New Orleans' population fled. The hospital's owner, Tenet Healthcare, ultimately chose to sell rather than reopen.
It was a market that, as you know, went from over 2,000 hospital beds to, shortly after Katrina, just 500 with some of the closures that we had.
Ochsner, then just a single hospital operator, stepped in to buy the hospital and 2 others in the area from Tenet.
I think Katrina was an event that, for a lot of reasons, people looked at it and said, This is our chance to do something different. This is our chance to be bold.
Since then, Ochsner has led the wave of hospital consolidation in the region, acquiring 5 additional facilities in the last 10 years, turning Baptist into one of its crown jewels.
We've invested well over $100 million of resources into this facility.
With state-of-the-art emergency operating systems.
In addition to this massive generator that can run all of the hospital systems, Ochsner moved all of the supporting equipment, the pumps and switches, well above the high water mark, and now has a dedicated fuel line in order to keep it running.
Katrina is a 1 in 100-year storm. We don't anticipate having to need them, but if we ever did, we're prepared.
Now, analysts say hospital operators like Ochsner have to be prepared for tough reimbursement battles in the wake of the proposed Aetna-Humana and Anthem-Cigna mergers.
Many are already getting ready by looking at their cost structure, becoming very efficient in their operations.
After the last 10 years, they feel prepared at Baptist for anything.
We were able to become very flexible, which is what you need to be in today's modern healthcare field.
Bertha Coombs, Nightly Business Report.
Our coverage of Katrina 10 years later continues tomorrow with a look at how Katrina transformed the city and how its recovery is still a work in progress. And that will do it for us on Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us and have a great evening, everybody. We'll see you tomorrow.